Hi students, in this week's lecture, we'll be looking at business planning and financial modeling. Before we can start though, we need to understand what our learning objectives are. So we need to understand the reason why we prepare business plans. We will also be looking at how to set out and analyze the essential components of any business plan. We will then look at the advantages of business planning, and then we will also inspect financial modeling relating to forecast financial statements, performing valuations, and various other corporate finance applications. We will also be looking at how to design a good spreadsheet which avoids errors. We will then have a look at the importance of business plans, and we will also have a look at financial modeling and their role in business planning. We will also need to consider spreadsheet models in corporate finance and financial modeling and forecast financial statements. We will then have a look at theory and practice. So what is a business plan? A business plan is a detailed report that outlines a business or a new venture and various information relating to the company's legal and ownership structure and various other factors. What are the objectives of a business plan? Why are business plans prepared? So business plans will be necessary if the firm is raising finance from banks or from various organizations such as the IDC. So the business plan basically enables management to properly match the company's capabilities to its growth expectations. So although a business plan should include information about a company's history and what has happened in the past, the focus should actually be on the future. So a business plan will be prepared at a point in time, and it will have little value if it is prepared for a specific purpose. For example, like capital raising. The business plan will need to be continuously changed or updated, and if it is not, it basically loses its value. So a company should prepare a business plan annually, forecasting into the future for about 3 to 10 years. So like I mentioned previously, the main objective of preparing a business plan is firstly because it will be a requirement if the company is looking for finance from various organizations like the IDC and a bank. However, the most important objective of a business plan is actually to enable management to properly plan the company's future direction and ensure that the company's capabilities match its growth expectations. So a business plan should include information about the legal and ownership structure of a company, the executive team, the firm's products, and what it deals in. It will also need to include information about the target market and marketing strategies that are used. It must also include information about the manufacturing processes and have detailed financial projections. It is also important to outline the social and environmental impacts of the company, and especially in South Africa, we need to consider the BEE rating, employment equity, and job creation profile of the company. So a business plan should include an executive summary that features the various information types. So the business plan must include an executive summary. In this executive summary, information should be covered, such as the brief history of the business. There must also be a description of the key concepts and unique offering that the business offers. Information about the company's products and services should also be included. We would also want to include a description of the market needs, market potential, pricing, and revenue. The company should also have an explanation of how it makes its products and provides its services. The business plan should also include a summary of financial projections and an outline of the experience that the executive team has. We would also want to include an explanation of how funds being raised will be used. These are all important and must be included in an executive summary. So there are various advantages of preparing a business plan, which is why it is done in practice. So one of the advantages is that preparing a business plan actually enables a realistic and integrated perspective of the business or product. So when a business plan is undertaken, it basically forces the company to analyze the market and identify the customers and the target market. It will also allow the company to determine its expected market share and have a look at manufacturing capacity. It is also important when preparing a business plan to consider Porter's 5 forces analysis and the SWOT or PEST analysis, but we'll discuss that a bit more in detail later. So when a company prepares a business plan, it enhances team building and communication and allows cohesion between all members of the firm. So it's important that all members of the executive team are involved and participate in the preparation of the business plan. If all key personnel and executive team members come together to prepare the business plan, it allows a unified strategic outlook and allows everyone to take part and have responsibility in the company's business plan. So preparing a business plan will also enable the company to determine the funding requirements and avoids any future liquidity crisis. So we would expect the business plan to have detailed financial projections over the next few years, and this would indicate any funding requirements depending on the cash flow generated from the operations of the company and also from its investing activities. So here we'll have to look at how much funding the company will need going forward and where that funding is going to come from. So when the business plan is prepared, we expect it to actually improve the firm's ability to obtain financing from places such as banks. So it will enable the firm to give insight to lenders and investors as to the company's progress in meeting its targets. So it is unlikely that the company will be able to raise the required financing if it has not prepared a business plan which is credible, which includes financial projections. So the business plan is a way that the company can communicate its progress to third parties. So a business plan will allow a company to plan ahead and decide when it will need to invest in property, plant, and equipment, when it will need to hire new staff, and when it will need to undertake product tests. So there will be a timeline that needs to be included in the business plan, and some projects may require the firm to invest in property and specialized technologies or equipment. So a business plan will set out the appropriate timeline of acquiring that equipment and when the investment cash flows will take place. So the business plan actually forces management to focus on strategic issues rather than day-to-day operational issues. So management often get bogged down when they deal with the day-to-day operational issues, and they often don't have time to look at the big picture. So the process of preparing a business plan will actually force management to confront the future and adjust strategies. The business plan will actually alert management to the need to obtain independent expert advice and undertake market research. So often when a business plan is prepared, it will alert management to the need to obtain legal, accounting, and any other expert advice, which will actually include market research services from independent experts. Often this market research will be undertaken regarding any future expansions or any new markets that the company wants to go into. So if we have a look at the next slide where we have more advantages to consider, the business plan will also ensure appropriate investment in IT, accounting systems, and internal control systems. When a business plan is prepared, it may make it glaringly obvious that the current IT infrastructure, accounting, and costing systems are not adequate. Therefore, any weaknesses identified in these systems can be addressed timelessly going forward. So one of the other advantages is that a business plan enables the company to adequately manage and plan for growth. So if a company forecasts that the demand is going to grow drastically in a certain product and the firm is not able to keep up with demand, or there is a drop in the product quality, this could have a detrimental effect on the firm's future. Also, when a company is experiencing high growth, this can place significant pressure on the management and may mean that the firm is unable to finance any increases in working capital. So, a business plan will also force management to justify its actions or plans. So, often companies may make decisions that seem to make sense strategically. However, it is easy to overpay and overestimate possible synergies. So, a business plan is also a strong indicator of commitment and credibility. So, the business plan is often the first but crucial step in obtaining finance. If a business plan is prepared well, it will mean that financiers can actually take the company seriously, and banks are more likely to give financing if they can interrogate the business plan and test the assumptions. Often banks will undertake due diligence before it agrees to give financing, and it will need to verify the financial statements and test any underlying models and assumptions that are used. A business plan will also allow for accurate monitoring of progress in relation to targets. So in a business plan, revenue and cost projections will be set, and this will include sales forecasts. This will enable management to monitor progress and will allow management to compare actual results to projected results. The time period that is usually reflected in the business plan can be anywhere from 2 to 3 years, but some business plans could consider time periods for as long as 10 years or longer, depending on the industry sector. So a business plan will be required to include the period of development, manufacturing, marketing, and sale of a new product. So a business plan will need to consider the various development periods prior to production. So if you have a look at this diagram here, the various components included in a business plan will be background, products and services, markets and marketing strategy, operations and manufacturing process, legal, social and environmental, executive team and key personnel, and financial projections. So if we have a look at the background or strategy of a business plan, this should focus on the company's history. So this section should convey what the company does, where it comes from, and it should also indicate where the company would like to go. So if a company has been operating for many years, it is unlikely to fail. So therefore, it is important to include this information in the business plan. So this section should also outline the organization of the business and should include a simple organization chart. So the background section should also include a section why the company needs the finance or why it is listing on the JSE. So it is useful to employ Porter's 5 forces model as a framework to ensure that the key business issues have been analyzed and planned for by management. So the business plan should also give information about the products and services of a company. So it is important that any competitive advantage weaknesses, and threats should be described in the business plan. Product life cycles must also be sufficiently discussed and forecast. The business plan should also include a description of the nature of the products. A business plan should not only include the nature of the product, but must also include marketing information. So a detailed explanation of the business model must also be included. The business plan should also include information about pricing strategies and special costs, such as research and development, that are incurred when a new product is being developed. So the business plan would also need to include a detailed explanation and analysis of production and manufacturing processes. If there are any legal or regulatory requirements for production, then this must also be included, as well as any legal requirements for distribution and sale of various products. For example, if a company was selling firearms, then it would need certain licenses and regulations to be able to sell these firearms. So a business plan should outline the size of the market for the firm's products and the market share that the company is wanting to achieve. It's important that a business plan is able to convey that there will be market demand for the product and the company will be able to protect its competitive position. Information should also be included in the business plan about the current size of the market. What is the industry growth rate expected to be in the future, and why is demand sustainable? Does the industry have a viable future? Is the industry currently undergoing major changes? And the business plan should also include information about how technology is having an impact on the market and any market trends that are also in place that could have an impact on the company. So the business plan should also include any information on government policies that would have an impact on market demand. This would include things like sin tax or sugar tax that will be included on certain products where the government is trying to regulate or control the consumption of those products. So the business plan should also clearly set out any sales predictions and market penetration predictions. The business plan should clearly set out any sales predictions and forecast market penetration. So the business plan should avoid overstating the market share or market size, as this can reduce credibility if the company is seen to be exaggerating. So the business plan should also match the capabilities with the projected growth rates. So it is vitally important that investors and lenders have a good understanding of the firm's operations and production process. So the plan should describe the manufacturing and production process with diagrams and photos if necessary in all stages of the production process. The business plan should also include any measures taken to ensure quality control and the use of IT in production to ensure product quality and inventory management. So any information about the distribution channel is important and should be included. For example, for an airline company, information would need to be included about its fleet regarding the age and fuel efficiency. Any routes and landing rights should also be detailed. So the company should describe its locations and distribution centers, if that is applicable to it. So information on the company's locations and distribution centers should also be included. So if the company owns or leases a building, this is important and should also be included. So a company must also detail its fixed production costs and variable costs per product. It is also useful for a business plan to include information about how a company's assets will be financed and whether the firm will own the assets or lease the assets. The business plan should also include information about spare capacity and prove that the company actually has spare capacity and the ability to sustain growth. If the company is wanting to expand production quickly, it will need to prove that there are growth opportunities available to it. One of the most important aspects of a business plan is to outline the experience and qualifications of the company's management team. So this is important when a company is looking at new ventures. But every prospectus or business plan should include detailed information on a company's management and executive team. So one way this can be achieved is by using an organization chart, which outlines the responsibilities of each member of the management team. So lenders and investors look for a balanced team in terms of the production, marketing, and finance functions. It is important to focus on the experience on each member within each function, but the plan should indicate the experience with the firm's products or similar products. So the business plan must also include the names of the members of the board of directors as they undertake increased responsibilities in terms of the Companies Act. And it's also important to identify the members of the audit committee. So it is important to show that the management team has the necessary qualifications in production, marketing, and finance. And of course, the chairperson should be an independent non-executive director. So on this slide, we have an example of an organizational chart. So this shows all the management and executive team members and will allow better understanding of the business plan and who is responsible for which tasks. It is also important to show details of the structures of control in the business plan. So if we have a look at the shareholders, the business plan should list the major shareholders and the level of equity ownership. It should also explain the background of shareholders and indicate any executive roles in the business. This is more relevant for startup companies, but is also relevant for established companies, particularly if they are looking at listing. So the business plan should outline the names, backgrounds, and experience of the executive and independent directors. The board is responsible for the management of the firm. The board's responsibilities have been expanded in terms of such aspects such as risk management and the appointment of an audit committee. So if we have a look at the executive management, and we have touched on this briefly before, the CEO and executive team are vitally important to the success of the company. And in South Africa, it's also important to indicate the progress of Black employees in executive positions. So in the business plan, any projections regarding expansion of operations should also take into account the impact that this will have on management structures. So although very flat management structures are often viewed positively, the reality is that a company will sometimes need to appoint middle management as the firm achieves its growth projections. So the company should also indicate how this will be achieved and put measures in place that will enable the company to promote from within or recruit the necessary qualified middle managers. If we have a look at employees next, we can see that it's vitally important to acquire employees that have the necessary skills and competence. So the business plan will need to address any issues of the availability of relevant skilled employees in the area of operations, and it should indicate the cost of employment. So the company will need to outline or address any training programs that are necessary to improve skills. So the business plan should also outline any cost of employment and benefits, and the cost of training programs as well. So if we have a look at external advisors, so the business plan must also address and identify the firm's legal advisors who the auditors are, and any consultants and the bankers that are used by the company. So the appointment of prominent companies will actually offer insights about the type of professional advice that the firm will receive in the future. So in this slide, we're going to look at the legal, social, and environmental factors that the company needs to consider when preparing a business plan. So if you have a look around us, there's often talk of the importance of sustainability and integrated reporting. So firms are increasingly being put under pressure to consider the social and environmental impact of the company's operations. This is very true in South Africa, as South Africa is currently facing significant social and environmental challenges. So a company will need to show how they are going to invest and increase employment and improve the opportunities for employees to acquire training and skills. So it's important that the business plan outlines the positive impact the company is going to have on employment levels, particularly if the company has set up operations in rural areas. So the company will also need to ensure that it complies with all necessary regulations and has obtained all the necessary regulatory approvals, permits, and licenses. This is particularly important in sectors such as mining and pharmaceuticals. And if they don't have the necessary permits, then they could face legal action and fines. So a company needs to be able to identify if there are going to be environmental factors. A company needs to be able to identify environmental risks that arise as a result of its operations. The company will need to give confidence to investors and lenders that any environmental issues have been addressed, are fully costed, and included in future cash flow projections. So this, for example, could be disposing of hazardous waste, and it could also relate to the restoration of the environment in cases where mining has been undertaken. So if we have a look at the next slide here, we are going to discuss financial information and projections. So basically, the level of financial information is going to vary depending on the nature of the company and whether the company was a startup or has been an established business for a while. It will also vary depending on whether the company is trying to obtain equity financing or debt financing. So in this section of the business plan, a company is going to take information about the market, the expected market share and sales growth and costs, and put it into a detailed financial projection. So the company will want to determine the profitability of the business over a future period, as well as the sensitivity of changes in profitability due to changing circumstances. The company is also going to want to determine any funding requirements from the detailed cash flow projections and make appropriate financing arrangements with its banks and equity shareholders. So various parties such as lenders, shareholders, and private equity fund investors make it compulsory that a company is required to produce detailed financial projections in terms of pro forma financial statements and cash flow projections. So lenders and investors will carefully analyze these projections in relation to other information in the business plan. And it will help those lenders and investors assess what financing the firm will need and how the firm will invest the financing raised from the investors. So long-term projections should also be included, and this will indicate refinancing and repayment of loans and cash flows to equity investors and lenders. If you think about the elements of the financial statements, it makes sense that the business plan should include projected statements of comprehensive income and statements of financial position for at least the next 2 years. It should also set out projected cash flows. So if we have a look at cash flow deficits, if a company introduces a new product or undertakes a major project, which often will be required to finance cash flow deficits for a period. Sometimes it could be for years. For example, when a new mining project is brought about, the company is actually required to finance the cash outflows. The same is true for the development of new products. It is important that the company discloses these projected finance cash outflows that will occur. So if we have a look at planning for contingencies, sometimes things may not go according to plan. For example, a mining project or a building may be subject to delays, or there could be cost overruns. So it is important that a company plans for contingencies and have some kind of financing available for any reasonable period of delay. So in a business plan, the financial projection section should include the following: historical financial statements and ratios. So this would be usually based on audited financial statements. Then projections will also need to be included. So this would include projections of the statement of comprehensive income and projected statements of financial position, as well as the cash flow projections. Financial ratios will then be performed on these forecasts and projections. So any calculations or workings of significant financial numbers also need to be provided so that the person reviewing the business plan can make sense of the figures and see how they are derived. If there are assumptions that are used, the business plan must also have a description of the assumptions that are used in the projections, as obviously the projections may not always be accurate. And if the assumptions are given, then it will help the person reviewing the business plan and the forecasts to assess if they are reasonable. So if we have a look at the business plan and the financial projections that are in the business plan, you will understand that these are based on assumptions and specific best estimates. So it is important to include in the business plan a what-if analysis. And this will be done by outlining the impact that changing estimates will have on the future profitability of the business, the impacts on the statement of financial position, and the statement of cash flows and the valuation of a business. If there are changes in macroeconomic variables, for example, such as interest rates and exchange rates, this can have a significant positive or negative impact on the future projections. So the company should indicate what the potential impact will be if there are changes in key macroeconomic variables. So the business plan will also need to give details about the accounting policies that the company uses, and will also entail detailed financial analysis of the company's current financial statements as well as the forecast financial statements. It makes sense that the financial projections will be analyzed, and private equity investors will use these projections to perform a valuation. The reason for the valuation will be to verify the financial statements and the assumptions within the model, as well as to verify market data. So the Industrial Development Corporation has financed many major investments and companies in South Africa. So the IDC actually requires companies applying for finance to provide detailed business plans. So the IDC provides guidance relating to the structure and content of the business plan. So the IDC requires the following major topics to be addressed in any business plan. So it requires details of FICA requirements. This can be tax clearance, incorporation document. So details of FICA requirements. This would include IDs, tax clearance certificates, and names of auditors and bankers. General information will also be needed, such as the details of the CEO, directors, organizational chart, group structures, shareholders' agreements, and any other history that is deemed relevant. The current business information, so the current products or services that the company offers and its social responsibility. A description of project or expansion plan will also need to be given. So this would be proposed products or services that the company wants to get involved in the future, the raw materials and suppliers that it needs, as well as the number of new jobs and any takeover information if it is planning a takeover. Details of key management personnel will also need to be included. This would be via CVs of the CEO, the financial director, project manager, and marketing manager. So additional significant industry information will also need to be included. For example, contracts, licenses, franchising agreements, budgets, distribution agreements. If we have a look at marketing information will also need to be included. So this would include size, future growth, macroeconomic factors, demographic effects, main competitors, estimated market shares, and various other information. Technical information will also need to be included. This would be on things like the manufacturing process, valuation of buildings, any regulatory requirements such as licenses, approvals, patents, raw materials, employees, and so on. Financial information will also need to be included. Financial information will also need to be included. Projected financial statements for at least the next 3 years, management accounts, interim financial statements, and any financial statements of holding companies if it is applicable. So the business plan must also include information on social indicators. This would be a scorecard and would include details such as the staff welfare, any environmental issues, safety, facilities, training, procurement policies, and corporate social investment. So throughout this year, we have looked at financial models to explain and apply corporate finance concepts. So we looked at time value of money functions. Remember, we looked at the NPV analysis when we did capital budgeting, as well as the internal rate of return. We also looked at risk and return, risk analysis with scenario manager, valuations of bonds and ordinary equity, as well as option pricing models. So when we look at financial modeling, it basically focuses on the design of the financial models. It sets out some useful tools as well as using financial modeling to set out projected financial statements, which will actually link up with the previous sections that were done, such as free cash flow valuations, which are crucial in any company valuation. So basically, financial models are going to form an important component of a business plan or a prospectus. We need to consider, though, the design and layout of the financial model. So in this second part of financial modeling and business planning lecture, we're going to look at financial modeling in more detail. Throughout this semester, we have employed financial models to explain and apply various corporate finance concepts. So we used time value of money when we looked at the NPV and internal rate of return sections in capital budgeting. We also looked at risk and return. We also looked at risk and return and valuations, and we valued ordinary equity, debentures, and other various securities. What we're going to do now is we're going to look at financial modeling and focus on the design of financial models and how to have, which sets out some useful tools. So the use of financial modeling, we're going to use financial modeling to set out projected financial statements, which will link up with previous sections on business planning, as well as other sections such as valuations and when we determined our forecast free cash flows. So the use of financial models is used pervasively in business. There are a few guidelines on what represents good practice. So what we're going to look at now is we're going to explain the principles of good model design, and then we will use evaluation to set our forecast financial statements, free cash flows, and financial cash flows. So financial models will form an important component of a business plan or prospectus. So the first issue we're going to look at when we need to consider financial modeling is the design and layout of financial models. So financial models will usually be laid out in Excel, and Excel enables financial analysis, and it allows accountants and practitioners to create and design applications to solve advanced business problems. When we set up our financial model, there are three crucial issues we need to consider. We need to consider the design and layout, the documentation, and the avoidance of errors. So if we have a look at the layout principles, so the layout of financial models will usually happen in Excel, and Excel will enable financial analysts, accountants, and practitioners to create and design applications to solve advanced business problems. The flexibility and simplicity often leads users to ignore important design considerations when they set their models up. So this may lead to poor documentation standards, and more importantly, it may lead to significant errors. So setting documentation standards enables users of the model to understand how the model works. So in corporate finance, practitioners who are setting out financial models should be aware of the importance of design and layout principles. They must insert appropriate documentation within the model and always be conscious of the potential for errors. So the design and layout of financial models will often assist in minimizing errors, but it is not a sufficient condition for avoiding most errors. So examples of poor design and poor documentation and errors in spreadsheets are often very effective in conveying the need for adhering to good practice in relation to designing and building financial models. So the integrity of a financial model and the ability to maintain a model as circumstances change and the ability to undertake what-if analysis is critical to setting up any model. So the layout of a spreadsheet model should follow certain principles depending on the application. So when we look at inputs, there should always be a separate section for inputs. All formulas should refer to this section for data values. Data values should not be included in formula, and input data values should be color-coded. When we look at outputs or results, the results of the financial model should be placed in a separate section that is close to the input section, therefore enabling changes to inputs to be analyzed immediately in terms of the effect on the results. When we consider calculations or cash flow section, for example, in capital budgeting or valuation application, this section depicts the cash flow per section. In capital budgeting, tax calculations should form a separate section, and in the valuation case, inputs may be related to each period. So this section should only consist of formula linked to values in the input section. So data values should not be embedded in any cells of this part of the section. It should only consist of references to the input section. When we have a look at sensitivity or what-if analysis, so in Excel, the data tables or tornado graphs as well as the scenario manager tool can be useful to depict potential changes in results to changes in inputs. If we have a look at the working section, workings are an important part of the spreadsheet design. So workings should be referenced and will enable preparers to reduce the complexity of formula used in the main section of the spreadsheet. So all of these principles we have discussed must be addressed separately to optimize the functionality of Excel, and in turn this will avoid integrity risk. So a cell formula should only include input value references to facilitate what-if analysis. So studies show that 20 to 80% of all operational spreadsheets contain errors, and 95% of financial models reviewed had at least 5 errors. There are different types of errors. There are qualitative errors and quantitative errors. So qualitative errors arise mainly from poor spreadsheet design. So although qualitative errors may not result in immediate errors in results, they increase the potential for errors once a user applies the what-if analysis or changes variables when circumstances change. So qualitative errors are indicated by the following attributes. So the structure. So lack of separation of inputs, calculations, and results can result in a qualitative error. Data embedded in formula. So if data are embedded in formula in different parts of the spreadsheet, particularly data that may be subject to change, it is not practical to change data in formula when a user wishes to undertake what-if analysis. It is much easier to simply change data values in the input section of a spreadsheet. Data is placed irregularly and haphazardly across a model, which makes it difficult to keep track of input values. There can also be complex formula within cells. Whilst it may not be possible to avoid complexity in relation to the use of functions, formula should be simplified as much as possible by, for example, creating separate intermediate calculations in separate parts of the worksheet. A complex formula increases the potential for errors if changes need to be made to a formula at a later stage. No documentation or poor explanatory notes can also result in qualitative errors. So use a separate worksheet to explain the parameters and objectives of the model. Use the cell comments facility in Excel to explain a cell's data or formula. So unprotected worksheets. If a worksheet is unprotected, this can result in it being accidentally overwritten. So it is suggested that worksheets are protected to avoid accidental overwriting. So there can also be a lack of data validation, which can result in qualitative errors. So it is possible to set limits to data inputs. For example, a discount rate may be limited to a feasibility range of between 4% and 40%. An error alert will mean that you cannot proceed unless a user complies with the validation terms. These are all attributes that can result in qualitative errors. So now that we have looked at qualitative errors, let's have a look at quantitative errors. So quantitative errors have been further categorized by Panko and Halverson into 3 major types. So we can have mechanical or accidental errors. These are things like mistyping a number or pointing to the wrong cell when setting up a reference or formula. So errors may occur when a user or developer accidentally alters a formula or value, or uses an existing model as the base for a new model, but forgets to update all formula and carries over information from a prior model. There can also be logic errors. Logic errors reflect errors in formula due to poor reasoning skills. There are also omission errors. Omission errors which reflect errors arising from data or inputs that are missing but should have been included in the analysis. These type of errors may be difficult to detect in a complex model. So there are also logic errors. So quantitative errors can also be logic errors. This reflects errors in formula due to poor reasoning skills. And the last type of quantitative error is an omission error. So here this reflects errors arising from data or inputs that are missing, but should have been included in the analysis. These types of errors may be difficult to detect in a complex model. So functions to enhance what-if analysis. So a key objective of a spreadsheet model is to undertake what-if analysis. The following Excel functions enhance the ability of a financial model to perform what-if analysis. So form controls. So the use of combo boxes, scroll bars, and spin buttons can assist in quickly analyzing the impact of changes in key variables on the result. The use of the offset function can also be used to minimize errors when doing what-if analysis on key variables, and this may be combined with the dynamic graphical abilities of Excel. So data tables can also be used. Data tables are very useful to depict possible results like the NPV of a project for a range of varying values of a key input variable. Using a data table, we can, for example, display the NPVs for a range of discount rates, or we can display the values of a company for a range of WACC and terminal growth rates. The Scenario Manager facility in Excel enables setting out a number of possible scenarios, combinations of input variables that may include worst case, best case scenarios. This may require some hard coding of input variables and often is undertaken as a separate exercise within a model. So tornado graphs. The use of a tornado graph is very effective at displaying the relative impact of a change of an input variable on the final result. This may be modeled within Excel, or it is possible to employ an add-in to Excel. So GoalSeek is also an effective tool in Excel which works backwards from a result to change an input variable. For example, assume you have estimated a future share price and determined based on this price and future dividend flows that the internal rate of return is 10%. Using GoalSeek, we can ask the model to work out the future share price so that a target internal rate of return of 25% is achieved. So Solver is also a function in Excel. It is an add-in function and it is an optimization tool which enables input variables to be changed subject to specific constraints so that the target NPV is achieved. We also have Monte Carlo simulation. This may be set up in Excel by setting up a capital budget with simulations. By, for example, employing the RAND function, it is preferable to use an add-on program such as Crystal Ball to perform detailed Monte Carlo simulations. So spreadsheet modeling is pervasive in practice. So everything we have discussed here, we are going to use in capital budgeting. We would look at also in leasing, valuations, financial analysis, and option pricing. So spreadsheet models are highly effective in explaining finance concepts, understanding portfolio theory, and efficient frontiers. Is facilitated by the use of an Excel model. The use of regression and scatter graphs may explain the use of betas and CAPM. Although the flexibility of spreadsheet models is powerful and its use is pervasive, spreadsheet errors are also widespread. If we are to use spreadsheet models in applying corporate finance principles and theories, then good design practices and how to minimize the potential for errors should be part of the process. Spreadsheet modeling should be integrated with the application of corporate finance, and the powerful what-if tools in Excel should form a key component in undertaking capital budgeting, risk analysis, and valuations. The application of spreadsheet models, particularly to such areas as portfolio theory, time value of money, capital budgeting, and option pricing, can facilitate our understanding of some complex financial concepts. However, financial modeling should be an enabler, and we should not become model-centric. The objective is financial decision-making, and the use of spreadsheet modeling is only a decision support. We have introduced the ideas of financial modeling. So you can have a look at example 20.1 for a thorough setup of a simple model to forecast the statement of financial position, the statement of comprehensive income, and operating or free cash flows and financing flows. So remember, we use these free cash flows to determine the value of a firm. Here we would actually be setting up the model to prepare the forecast. So this is an example of what we have just discussed. Here it shows the sections where we'll have the cash flows and calculations. It also shows the sections where we'll have results, and then we'll also include a section for the what if analysis, which we spoke about, and then there'll be a separate section for workings. So you'll see in your textbook that they have a forecast income statement and a statement of financial position. So this is used in valuations. So remember in valuations when you did the free cash flow to the firm approach, they usually gave you the free cash flows or you had to calculate it. This is an example of how it would be displayed in Excel. So how do we determine the plugs? So the plugs will be either the cash generated from operations, which builds up in cash balances, or debt balances required to finance operations and investment assets. So if we have a look at the trial assets and trial liabilities in the textbook example, you'll see that these are totals which exclude the plugs of cash and debt. So also have a look at the if function in Excel to determine either the cash or debt balances in the projected statement of financial position. So have a look at the example in the textbook, and as this will give you more information. So in conclusion, so based on the lecture and the material we have just covered, we can see that it's important to have the inputs in the separate sections. It is also important to validate the data that we are inputting and to make sure we are documenting the information properly. We also saw that it was important to set the value next to the input section, and we must set out our forecast income statements and statement of financial position to determine the financing requirements. We must also make sure to keep the formula as simple as possible, as this will avoid errors rather than to use intermediate workings. We also had a look at using if statements in Excel and GoalSeek, as well as Monte Carlo and tornado graphs. So have a look at the examples of these in the textbook. You could even do it in Excel if you want and experiment that way. So we also had a look at what if analysis and stress testing of the models. And here we use extreme values and we see how the outcome changes. We also used reasonability checks. So what is the terminal value multiple in the terminal year? We also need to make sure we don't use shortcuts when we are preparing these models, as this could actually lead to problems later on. So rather do it the long way to avoid modeling errors. So financial modeling is used in all areas of corporate finance. So it's important that you are familiar with Excel and you know how to use Excel. So the use of Microsoft Excel is pervasive in practice. So this textbook really just introduces the idea of financial models in Excel, but you are familiar with the concepts of time value of money, valuations, portfolio theory, valuations, capital budgeting, and working capital. All of these sections can use Excel. So Excel is also used in forecasting cash flows for valuations, working capital, and capital budgeting. So even though Excel models are a useful tool that are used in practice, there can be many pitfalls to Excel models. So often there can be a lack of documentation, which makes the Excel models unreliable. Only the author who has prepared the model actually understands what is going on in the model. So sometimes it can be difficult for someone else to understand the model. So it's important to make sure there's enough documentation explaining the model. There can also be a lack of structure in the model. There can also be errors if cells are not protected and they are overwritten. Sometimes the Excel model can contain structural and conceptual errors. There's also difficulty when models are audited, especially the models that involve forecasting free cash flows, because these forecasts are often subjective and based on judgment. The model may not be expandable and flexible to deal with varying situations. So if we have a look at more details about the modeling errors, there is no documentation or poor explanatory notes. This can lead to modeling errors. So it's important to use a separate worksheet to explain the parameters and objectives of the model. So we did discuss this earlier. We also discussed earlier that if we have worksheets that are not protected, they can be overwritten. So it's important that formula are protected. We must also make sure that no use is made of data validation. Another common error is that data validation is not done. So Excel actually allows the parameters to be set to limit certain data inputs. For example, a discount rate may be limited to a feasibility range of between 5 and 35%. If you try enter any percentage outside of this parameter, an error alert will be produced, and this will not enable the user to enter this input. So the use of combo boxes are also effective to limit the possible changes made to a model's input values. So modeling errors can also result from a poor layout, a lack of separation of inputs, calculations, and results. We also understand that if we want to perform a what-if analysis, it is difficult to implement if certain data has been hard-coded or embedded in the formula. Complex formula also increase the potential for error if changes need to be made later to a formula. So here we have an example of data tables. This is in chapter 20 in your textbook. So data tables here indicate a change in the value of equity if we change the terminal growth rate and or the cash operating cost to sales. Click on Data and What If Analysis and select Data Table. Data Table for the valuation example in chapter 20. It is also possible to have circular references in Excel. So for example here, if equity depends on the interest expense, which depends on the debt balance, which depends on the equity balance. So try and avoid circular references in models if possible. For example, let the interest expense be based on the prior year's closing debt balance. So it is not always possible to prevent these circular references, but it is recommended. So we also have we have Excel for Mac and Excel for Windows. You can have a look at that. Is there a way to avoid circular references and still use closing balances? So have a look at the example in your textbook on using circular references. So if we have a look at the summary of financial modeling, we looked at the objectives of the model. We also looked at the input data. We also saw the importance of having the input data in a separate section and highlight all inputs to the model. We also saw that it's important to have references to input data, results near to input data. We also need to set out the model and reference to working section. It is also important to have an area for sensitivity analysis and data tables. It's also important to use interactive graphs, as this will help you interpret your results and how they change when the inputs change. We must also make use of borders and colors to depict inputs and results and to make the model more understandable. It's important to keep your documentation correct and set out the worksheet with all relevant documentation explaining the structure of the financial model and the objectives. So all of the above is really based on the level of complexity. You have simple models and then you have more complex models. So both, if you are still using the 8th edition, there are examples in there as well as the 9th edition. The chapter hasn't changed. So Excel is critical for applying the principles of corporate finance in the real world. Okay, doesn't make sense to write out evaluation on pen and paper when we have Excel. So Excel is a great tool that can be used when performing financial modeling. However, it can also result in errors. Therefore, it's important to follow the principles of modeling, such as avoiding hard coding, protecting the model, and also including validation checks. We also need to ensure ratios are used and ensure that free cash flows equals financing flows in valuation models. This is the end of the lecture. Thank you for watching. But please make sure you have a look at the examples in your textbook and read through the textbook. There are some useful tips and examples in there that will help you understand this section more.